Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. This is going to be the first video in a mini-series I'm doing on superannuation. I did a video last year going into the basics, but for this year, I'll do a deeper dive as there is a lot that people need to know, and it's quite a complicated topic. For those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FASI compliant, and I specialized in super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I left the industry as I could not stand the owner of the business, and I've got no interest in sales. I mean, it's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work with tax. So this series will be broken up into about 6 videos. Not guaranteed yet. We'll see how the edit goes. If they're longer than I'm expecting, I might split it up into smaller, more tolerable chunks. I'll be releasing each video in the series about once a month, so there's not too much of an overload on you guys. If I was to talk about super for months straight, I think I'd lose all my viewership. Now, once I've released all the videos, I'll probably do a compilation. So if you don't want to watch each individual one, just watch the compilation when it comes out, and it'll have absolutely everything that you need to know. Now that I've got the house cleaning out of the way, let's dive into super. Previously, we discussed conditions of release, the different types of funds, industry, retail, and SMSF, and also how they invested those funds. Finally, we briefly mentioned salary sacrifice. I'll be covering a few of the same topics, just in a bit more detail, over the course of the next 6 videos. Today, we'll be focusing on the accumulation phase of super, specifically super funds and the purpose in general when it comes to retirement. Let's start from the beginning, okay? The first thing that needs to emphasize is that superannuation is a special type of trust, SPV, or Special Purpose Vehicle. And the special purpose of super is to help pay for your retirement. If you watched the previous video I did on trusts, you'll remember that I said that all the income of a trust needs to be distributed, or the trustee will pay tax on it at the top marginal tax rate of 45%. While super is a trust, there's an exemption for super funds, and that's under Section 99 and Section 99A of the 1936 Income Tax Assessment Act. And funds are allowed to accumulate income. Trustees are still liable to pay tax, not the members, but the rate is lower, and I'll go into that later in the series. Up until fairly recently, there wasn't much choice as to what super fund you could go with. This changed on the 1st of January 2021 and meant that employers are able to choose whichever super fund they want, rather than being limited to the one that their employer specifically offered. Well, it came in then. It actually took a few years for changes to really happen. I used to work for a supermarket, and their default fund was Rest Super. This was written specifically into the EBA. I can't remember when that EBA expired. It was many years ago. But even though the laws said you could choose your fund, the EBA did not allow it. And this was allowed to continue until the next EBA was voted in. And that was after I left. It goes to show that even though technically employees had more options about where they could put their super, it wasn't actually allowed through a lot of employers. Thankfully, I think all EBAs have expired and have since been renegotiated, and now everyone can freely move their super. But yeah, there was a time when legally you could move your super anywhere you wanted, but your employer didn't have to accept it. When the choice of funds opened up employees to whatever fund they wanted, this also led to something called the stapled super laws. What is stapled super? So stapled super was a new introduction by the Liberal government. And what it meant was that if you had a super account from an old job that met the conditions, your new employer would have to pay to that old account, and they couldn't just create a new one with their default super fund if you didn't provide them with the info. Now, let's be honest, how many people actually know the super details? This is why I have my channel, because I've come across so many people that do not know the basics of personal finance. And if this is you, I hope you watch my videos and you grow that knowledge. But yeah, as I was saying, most people have no idea. So if they don't know, they can't tell their employer. And so this saves them from having multiple super accounts with different providers, paying multiple sets of admin fees and insurance and other fees, eroding their balance and reducing their retirement savings. Now, not all super funds qualify to be a stapled fund. The conditions mean that it has to offer a My Super product. My Super product being a single diversified investment strategy. This means it's invested in a range of different equities in the one single product. It's got Australian shares, international shares, property, bonds, and cash at a minimum. Now, most of these products will be rated as balanced. They have a growth percentage between about 70 and 80%. Another condition to be a stapled fund is that they need to have default insurance that comes with a minimum level of death cover. The vast majority of super funds allow you to hold insurance through the fund. However, not all of them will provide it to you as a default. Most industry funds would. I haven't met any that don't. But yeah, insurance needs to be an opt-out rather than an opt-in. There also needs to be limitations on the fees that they charge. Most retail funds wouldn't meet these conditions, but industry funds would. One thing worth mentioning is that this only applies to employees that started on or after 1 November 2021. So if you started with the employer before then, they wouldn't have been able to see your stapled fund. Hopefully by now you've told them and they're paying you properly. But next time you move jobs, your employer will have your stapled fund there to contribute to without you needing to do anything. Along with stapled funds also came the Your Future, Your Super legislation. And what this is doing is each financial year, the government releases a comparison of different super funds showing the performance of their MySuper products against every other MySuper product on the market. This is designed so that you can have a look at how your fund is doing each year and whether they're performing to the level that they should. If they're not, you can see what other funds are meeting the benchmark and maybe you can move. The benchmark gets updated each year because obviously the market changes each year, and you can't have it at a set growth percentage because some years you'll see every fund outperform, and other years everyone will underperform. And it's not a very good measure of comparison. What the government does with the benchmark is if a fund underperforms the benchmark multiple years in a row, it locks it from acquiring new members until they can improve. What this has meant is that for a lot of smaller funds is that they're not meeting the requirements. Instead of waiting for government intervention, they've been merging with other funds quite early on, and that helps consolidate the investment strategy, and it gives them greater economies of scale, resulting in increased performance. What a lot of industry funds have been doing to grow the membership base to get to that economy of scale is advertise. Now, this is actually really controversial in super legislation. In order for the trustees to spend money that it gets from members such as admin fees, they need to prove that it's in the best interest of the members. Now, this legislation was then changed at the end of 21 from best interest to best financial interest. I would argue that advertising is not in the best financial interest of the fund, but they've gone away with it for years, so we'll have to see. What most people would be familiar with is something called a defined contribution super. Everyone nowadays would have one of these. What does this mean? A defined contribution is if you work a job. Let's say you earn $100,000 a year and your super guarantee is 12%. So that's $12,000 a year. That means each year you're putting in $12,000 into your superannuation. The contribution is defined. You have your own account, you have your own balance, and your balance is 100% reliant on your contributions each month or year. If you don't contribute, the amount might go up or might go down based on returns and fees, but it is segregated specifically to you and is reliant on what and how much you put in. This contrasts with something called defined benefit, in which there was no real defined account. So these defined benefits, they've been wiped out as they're mostly government funds, and they're no longer open to new members. And as these older members die off, the number of account holders reduces. What is a defined benefit super account? It differs from a defined contribution because generally the amount you put in is irrelevant. You don't have a distinct account balance. All your funds are pooled into one account, and there's some magic formula that they use once you start drawing a pension as to how much they give you. It's normally a factor of the last 3 to 5 years of your income multiplied by your service period and then by some other number. And this amount is then paid to you for life. It gets indexed each year in line with CPI. However, how much money in the kitty is irrelevant. Whether the market went up or down is irrelevant. If the country is in recession, it's irrelevant. None of these factors in how much you get paid. The reason these defined benefit accounts have been closed to new members is because they were so generous that the government was losing money offering them because they were mostly government employees. And so if there's not enough money in the fund to pay out members, it's on the government, i.e. taxpayers, to fund the retirement of these people. There are 5 different types of super funds, as I briefly mentioned in my first super video, being industry funds, retail funds, SMSFs, small APRA funds, and government super. These are the different breakdowns of how popular each super fund type is. As you can see, industry funds are the most common. However, in terms of actual dollars, SMSF and industry funds are both at a very similar level. When you compare how much assets is held in super environment, you'll actually see that there is more money in super than the total market cap of the ASX. With the ASX being $1.6 trillion in total assets, super being $1.5 trillion. That is huge. Basically, if super funds only invest in the Australian stock market, they could own all of it. That'd be really bad for the economy having all your wealth consolidated and controlled by only a few entities. Interestingly enough, super is much larger than the GDP of Australia. We could buy every good and service produced in a year about 1.5 times over. As you can probably imagine, when I said earlier that industry funds has the most members, in terms of dollars, SMSFs had the same amount, but there were probably some really large SMSF balances. The largest SMSF has about $400 million in 2020. What? How can you accumulate that much money? It's absolutely insane. And if you look at the Tax Expenditure Insights, also known as TICE, released by the ATO and Treasury each year, you'll see that super as a whole is costing the government $1.5 billion from the concessional tax treatment. I'm going to wrap it up here for now, as the video is getting too long. Make sure to come back next month for part 2 of this 6-part series, where I'll talk about superannuation guarantee. Hopefully I'll be able to give you a better understanding of the basics. What are superannuation accounts purposes, the difference between defined benefit and defined contribution amounts, and stapled super and the Your Future Your Super. If you have any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.